Joining me on today's Lender Spotlight is Andrew Smalley of Movement Mortgage. Welcome.
Thanks so much, Dennis. I appreciate you having me on.
Okay. Thanks for joining me today. And so we want to start with just talking about the current state of the real estate market and how you see things happening now. I know we've been talking about rising interest rates and things like that. And how do you assess the market at this point?
Yeah, that's a really good question and one that I've been getting quite a bit lately. The one word I would use to describe it would be a shift. It was a seller's market for such a long time, and now to see the advantage go more so to the buyers has been really good. People are being able to put offers in, asking price, under asking price in some cases, being able to get homes with inspections. And again, that just wasn't the case, 6 to 12 months ago. So it's really nice to see that shift. And I know rates have gone up, which is certainly no secret, but at least there's a little bit of an equilibrium there where people aren't having to go 50, 100K over ask, which seemed like such a normal thing. And they're not having to compete with dozens of offers. Someone can now go to an open house on a Sunday and actually take some time before putting in an offer, where before it was like, you look at a home on Sunday and you better have your offer ready to go on Monday. And, when it comes to the biggest purchase of someone's life, people usually want some time to think it through and make sure it's the best decision for them and their family,
Absolutely. So what do you services do you provide to your customers and to your the real estate agents that you partner with? I know you've been a good partner with a lot of the Century 21 Celli agents over the time. So what exactly what do you do when you have a potential buyer looking to get a mortgage?
Yeah, I think that the biggest word I would use would be education. I really enjoy doing that with people, going over the pros and cons of different loan programs, like an FHA versus conventional, or even a lot lately has been the adjustable rate mortgages. So I think just educating people on the biggest purchase of their life is so crucial. And I would say that's probably my number one thing I love doing with people. And I'm relatively new to mortgages, been in the business for about a year and a half, but I spent about a decade in the car industry. And so I have a lot of history in sales and working with people. And so much I've found success in is just taking the time and really educating people to make sure they're aware of all their options.
Great. Well, let's talk about one of those options right now. Which is fixed rate versus adjustable rate mortgages. We used to hear a lot about that topic, but it's sort of slipped by the wayside now. So can you sort of explain to us what the advantages are for each?
For sure. And adjustable rate mortgages, we haven't heard much about them, like you said, in the last few years, because when rates were at 2 or 3%, there wasn't a whole lot of incentive to do an adjustable rate mortgages. But now that we're in this kind of, a little bit more of a volatile rate environment, they're becoming a lot more beneficial to borrowers. And I think it's important to kind of take a step back and look at the history of ARMs, because what an adjustable rate mortgage was in 2007, 2008 is very different than now. They used to have something called an interest-only ARM, which means for the first 1 or 2 years, the rate it's fixed, but you're only paying the interest on the loan for the first 2 years. And then it'll adjust on that year 2 or 3. And what happens then is the rate skyrockets, and then you add principal into that payment. In some cases, someone's payment would double, wouldn't be able to afford the payment anymore, would be forced to foreclose on their home. And it was a really just bad situation to be in. So those ARMs are just very much a thing of the past. They are much better now. There's a lot more things involved that protect the buyer. There are caps in place, so you know exactly how much it'll adjust, what's the lifetime cap it'll adjust. And they're usually fixed for 5, 7, or 10-year increments. So it gives you time to build some equity in the home. So when it comes time to refinance out of that ARM, you're able to do that because you have some equity in the home. And I have found a really good way to explain an ARM is using an example of a personal example that I actually did about a month ago. I went over 2 options with the borrower. We looked at a 30-year fixed as well as a 5/6 ARM. And a 5/6 ARM means it's fixed for 5 years, and then it can adjust every 6 months after that.
So just to clarify, ARM stands for adjustable rate mortgage, right?
Yes, sorry about that. I should have clarified that. But yes, yeah, ARM is adjustable rate mortgage. So the 30-year fixed in the example I did about a month ago was 7.125%. the 5/6 arm was at a 6.125%. So a full percentage point difference. What that did to the client's payment is it dropped it by $250 a month. So then we kind of do some math and see, okay, does this make sense? Because when you purchase an arm or choose an arm, they're going to come with something called points. And basically, to put that in simple terms, anytime a loan is deemed a little bit more risky, they will require a little bit more money upfront. Basically saying, hey, we want a little bit more cash up front, we'll give you a lower rate, but it's just, again, deemed a little more risky. A good analogy to that would be, let's say you own a home and you bought an investment property. Well, the investment property is a lot of times going to come with points because it is deemed more risky. In the event you lost your job or something horrible happened, you are much more likely to default on your investment property than you are your primary residence. So an ARM, basically the math we do, and in this exact example I did, the cost of the ARM was $3,000 and it saved the client $250 a month. So you simply take $3,000 divided by 250 and you get a number of 12. And that represents the amount of months it'll take for you to recoup your $3,000 purchase of that rate. Yeah. Then everything after that, you're going to save $250 a month, $3,000 a year, $6,000 in 2 years, $9,000 in 3 years. So it's a great option when we're dealing with this kind of volatile rate environment. It is certainly not for everyone, but I think it's very important to make everyone aware of it. To again, go back to what I was saying with educating the clients is making sure they're aware. And then at the end of the day, whatever works best for them, I will support. But giving them the options, I think, is such an important part of the job.
Absolutely. Well, you definitely explain it very well. So tell us a little bit. So you said you were in the car industry, and so you've been involved with mortgages for about a year now. So what is it why the switch? Why did you move over to the real estate industry? What do you love about the real estate industry?
Yeah, it's a good question. I've always loved helping people. That's been at the core. I started selling cars when I was 19 years old. So I've just loved, sitting down with people, building really positive relationships, asking them the right questions, and then pairing their answers to the right car, or now my case, the right answers to the correct loan product. And then even in between that, I actually had another stint. I lived in the Virgin Islands for 2 years, and I actually sold timeshare. Which was a job I was not good at, to be perfectly honest with you, because that's a little bit more of a high pressure sales job. And there's not as much of that relationship building. It's kind of like, hey, you come in for 90 minutes. I got to sell you now. And if I don't, I never talk to you again. And that never really sat right with me. So this is much more rewarding. I get to, guide people through the biggest purchase of their life. I get to join them at the closing table and celebrate with them, get to educate them every step of the way. I mean, I will be in this industry for the rest of my career. That's something I certainly know for sure.
Yeah, wonderful. Great. Well, thank you very much for joining us today. Is there anything else you wanted to mention before we close?
No, I've always been a believer that when it comes to things like this, everything starts with a kind of a friendly, no obligation conversation. Because I think that sometimes people get really hesitant when it comes to, the mortgages or looking at credit. And it's just starting with just a very easy, non-pressure conversation, whether you're looking to buy a year, 5 years, tomorrow. I just think starting that call is so important to kind of get the ball rolling and just start learning about what the process looks like.
Great. Well, Andrew Smalley from Movement Mortgage, thank you for joining us today. And again, this is Dennis from Century 21 Celli, and this is our web series Lender Spotlight. And thank you, and we look forward to having you on again.
Thank you very much, Dennis. I really appreciate it.